Hello. Advanced Auto Parts crashed following its earnings report. And so I wanted to take a look. In this video, we're going to analyze the company a little bit because it went down about 35%, I believe. We can use our tool here and see the exact value. Taking a look at the metrics page, you will see that the stock was actually down 35% and it's actually down even more pre-market, about 2.6%. So we're currently sitting at about 71. And a lot of you may be wondering whether this is a price to buy at. Now, you can see the 5 years chart and all of a sudden we are dipping. So we are below the 5 years chart over here. It's looking like it's one of the best prices that you could potentially get since 2014, actually, and less, even before that. So it's a low that is rare to see. But does it make sense to buy is the question. We are going to examine that in a little bit more detail. This is a pretty well-known company. Again, you can take a look at our company profile page here and see that it provides automotive replacement parts, accessories, batteries, and all that stuff. So it's a company that, again, it's a pretty big one, and it has suffered. Let's take a little bit of a look at the earnings report just to see what happened. So, Advanced Auto Parts misses profit estimates, cuts outlook and dividend. And as I've said before, I've said it in the past, when a company is paying quite significant dividends and suddenly has to cut that dividend, it can really suffer. And it can actually suffer for a while till all these investors that have been into the company, they slowly learn about the outcome, and they are slowly taking their money away, because a lot of these investors are actually like passive income investors, and they are actively trying to get companies that are paying lots of dividends. So as the company slashes its dividend, it now becomes sort of like a growth company, if they can manage to grow, because they are actually going to be preserving some of their free cash flow by not distributing that dividend. And you can see in our tool here, if you take a look at the stock analysis dividends page, you will see what the company has been paying. Right now over here, they have been pretty much abruptly increasing their dividend in the past few years, and now they had to slash it tremendously. So they used to pay 1.5, I believe they actually brought it down to 0.25, so that's a pretty significant decline. Let's examine the actual details here. And this stock is obviously performing really bad, and as they are increasing the quarterly dividend by more than 83%, you can understand that we could potentially see a decline for the next month or two, even, again, as the news propagate pretty much. So the company reported fiscal 2023 first quarter earnings per share of $0.72, well below analyst estimates of 2.57. That's a massive decline. The expectations were insanely higher than this. Revenue rose 1.3% to 3.42 billion. It's a pretty big company, but it's also short of predictions. And they did blame the disappointing numbers on higher than expected costs. As you'll see, supply chain issues, the known stuff, understandable, but still, the outcome is not looking great here for this company. And they also slashed the dividends. It's a big issue. And again, this is why I have been warning investors to be wary about the dividends, especially right now, as we are having these companies which have faced some issues, issues from the lockdown, issues from the supply chain. They can actually be forced to cut down on dividends, and you really don't want to be holding on to a company that is not paying a dividend anymore, and also it's not growing. This is a problem. But as a new investor, you can kind of see whether there's a little bit of a leeway there to potentially buy this company and see what it's going to be looking to be doing in the future. But if you were a shareholder and you're actually facing this 40% decline, it's just not looking pretty, and this is why I would avoid such companies where the actual free cash flow that they can distribute is not well above what you would want as a shareholder. Now, they anticipate full year EPS of $6 to 6.5, which is again far below the earlier guidance of $10 to $11.2, much different than what they anticipated. And it predicts net sales of between 11.2 billion and 11.3, again down from the previous forecast, but not that much. So it's mostly the net income that has been suffering tremendously here for the company due to all these issues that we have mentioned above. Although the suffering is quite steep if you actually account for the fact that their sales are not really down that much. And this is why I have talked about it in the previous videos. You don't just look at the revenue, because the revenue can be masking all sorts of problems. And you see it here. The expenses are so high that the revenue basically doesn't really make much of a dent here in the stock price. And the company also slashed the quarterly per share dividend, and that's obviously the elephant in the room. 0.25 cents from $1.5, that's a significant decline. And again, you're going to be looking at all these investors who were there to grab the dividend, exiting the stock soon. And I think this will probably happen in the upcoming 1 or 2 months. It's usually not instant. It takes a few trading sessions for all these shareholders to be shaken out of their positions. That's the usual thing. You never really know exactly, but that's the usual thing. And you can kind of see the decline here. Now, as new shareholders, does it potentially make sense to maybe add a little bit of this one to a portfolio? Before we examine the financials, because obviously the financials matter a ton, the thing to remember is that you may want to step aside when this kind of thing happens, where you have a massive decline, where you have a dividend cut. You may want to step aside for a few trading sessions and just wait for this thing to stabilize and see what you're going to be doing with it a little bit later. You're not forced to trade today. So being patient in the stock market is a virtue, and it's very, very important. So this is what I would do, and this is what I do in these kinds of situations. I like to wait. I like to wait, see how this reacts in the next maybe couple of months. But it does pay to know today whether this is a buy or not, for sure. Because we can have it like in a watch list, a short list, and follow the prices and all that, see how this is going to be behaving in the upcoming months. Now, again, you can kind of see the decline here. It's precipitous, and it could be a fantastic price if it is a bargain here. Now, as the P/E ratio goes down, we are sitting at 5.7 over here, which is tremendous, understandably. The company's stock price is down that much that we are sitting at a very, very low P/E. And this is understandable. I mean, this kind of dividend cut, bad news for the company, slashing the guidance, slashing expectations. The decline can be so deep, even in a couple of trading sessions, that it can actually be much more than it would make sense. And this is where some investors are around potentially capitalizing of such situations. Now, the price to free cash flow is still not that great, sitting at 14.6. But what you do love to see is the fact that the company has been buying back their shares by a bunch, frankly. So they have been buying and buying and buying, and obviously that's pretty nice. I know this buying is dropping the P/E ratio, is dropping the price to free cash flow, and generally speaking attributes more income to shareholders via EPS, for instance, although their financials have been deteriorating as well in the past couple of years, it looks like, or I should say the last year, basically, where they're actually suffering the situation, suffering the results of the situation, pretty much. And they do have quite a few liabilities here, which is important, very, very important to notice, quite a few liabilities and quite some debt. And this is something that I don't like to see, because when you have that much debt, you really, really have to keep making quite a bit of free cash flow, quite a bit of net income. You need to keep selling quite a ton. And as your net income decreases, as your free cash flow decreases, and you have that many liabilities, that much debt, it's just not looking great. And this is something that it would definitely play a significant role. And they have been buying back shares, but they have been increasing their debt as well. And that's something that I just don't like to see. It's not great. However, in some situations, you do want to examine the equity as well, because the equity does go down if you're actually buying back shares. So they could have caused that, for example. But again, with this kind of total liabilities compared to the free cash flow, that's pretty significant here. There's quite a lot of liabilities compared to the free cash flow. We'll examine that in a little bit more detail. With the net income margins pretty much being a little bit higher recently, overall they are a little bit lower. But again, their net income has been suffering. And as you'll see here, their distribution was already showing issues with the free cash flow payout ratio being that high. Now, let's take a little bit of a look at the statements themselves. 9.5 billion back in 2018 and 11 in 2022. That already shows a little bit of trouble in regards to growth. So this company doesn't really grow much. And this can be problematic if you are buying at a high price. But it could be okay if you are buying at a very low price, is the thing. And this has actually been dropping quite a lot. So that price could be okay when this specific revenue is, is regarded. Now, their net income, it's again about the same, 423, 541. It's basically the same. It's not really increasing much. And remember, this is the fiscal year 2022. And the balance sheet over here, you can kind of see that the total equity of the company has been dropping a little bit. Remember, though, they have been buying back shares. This is why this is negative additional operating capital. They have been distributing capital for buying back shares, and this is why the total equity is going down, and this is why you are looking at a higher debt to equity, which may not be exact in the sense of a percentage, but you can kind of see the exact numbers here, like 1, 2.7, 3, 3.3, 3.6. They are getting a little bit of extra debt, that's for sure. It looks like it could be okay, it could be serviceable, like 3.6 over here. You always want to take a little bit of a look at the cash flow statement, just to see what they are making here, about 300 million. So again, the debt is significant compared to the free cash flow, that's for sure. But they were making significantly more free cash flow in the previous year. So, if they go back to their normal free cash flow, this could actually stabilize itself quite significantly. So there is definitely some risk, for sure. But if they manage to go back at what they were doing, this may be an interesting case. But it's worth noting all this information here, and this is where it helps to actually analyze with a tool like this, for which we can get access at myinvestorsheaven.com if you're interested, by becoming a patron. All the links in the description box below this video. But the next thing and the last thing that we're going to be doing, and it's very important, is examine the stock evaluator, the discounted cash flow model. Now, the revenue growth of the company has been sitting at about 1, 2, 3%, and this is what I'm going to be using. And I was taking a little bit of a look at what analysts are predicting, and this is where it's at about 1, 2%, 3% in some years for the upcoming 5 years. And the net income margins overall for the company have been sitting lower at about like 4 to 5%. So this is what I'm going to be using. Maybe 4, let's go 4.5 and 5. And you can see some increases and declines in a quarter, but you kind of want to take a look at the overall year's net income margins, and the free cash flow margin slightly more than 100% usually. So I will go 90, 100 and 110 here, and an annual return of 13%, just to see what the discounted cash flow model points at. And you can kind of see that the current price is so low that the max price to pay is sitting at 93 for the low estimates, 122 and 156 for the high. So this looks like a potentially interesting buy, but again, you have to take into account the facts that we talked about: the slashing dividends, the fact that the company has not been growing lately, pretty much just very low growth over here, but it's cheap. So you could potentially buy it at 70, for instance, and it could probably grow to 150 eventually, maybe. It may take a while, of course, but you could definitely see it getting to the previous levels if their financials stabilize and become what they used to be. So it's a little bit of a risk here. Now, what I would do, I would probably not buy yet, as I said, because I do want to see what's going to be happening. I don't really want to be messing with these kinds of companies when they drop down that much, but I want to be lurking around and see where this stops. Maybe where the bleeding stops, maybe it stabilizes a little bit. I kind of want to see sort of like a basing pattern, maybe near 65, for instance, if that happens. You may want to see sort of like a base here being formed near 65. I don't know if I have an example, for instance, something of this sort, some sort of a level where it kind of stabilizes a little bit, and most traders are kind of trading at the same levels. This is where I would probably like to enter if I were to enter this company. Not now, because this is going to be erratic for a while. Thanks for watching, guys. Tell me what you think about Advanced Auto Parts. Leave a comment below, and I'll see you in the next video. Bye-bye.